Healthcare isn't just a medical system. It's also an economic system. And once you understand the financial incentives underneath it, many of its most confusing decisions suddenly make sense. Start with this one. There is a federal law that legally caps how much profit your health insurer can keep. And your health insurer has never made more money in its history. 7 companies, United Health, CVS's Aetna, Cigna, Elevance, Humana, Centene, and Molina, brought in nearly $1.7 trillion combined in 2025. More than $54 billion of that was pure profit. Here is the part that should genuinely bother you. Those same 7 companies covered 10 million fewer people in 2025 than they did the year before. Fewer customers, more revenue, more profit, all at once. By the end of this video, you will know exactly why a law capping insurer profit did not actually cap much of anything, and why 2 out of every 3 people with coverage through their job are not even protected by it at all. The medical loss ratio rule, often shortened to MLR, sets a specific floor on how insurers can spend the premiums they collect. In the individual and small group insurance markets, insurers must spend at least 80% of premium income directly on medical claims and quality improvement. For large group plans, typically the ones offered by bigger employers, that floor rises to 85%. In both cases, the remaining slice, 20% or 15%, is what the insurer can keep for administration, marketing, and profit combined. If an insurer fails to hit that threshold, it owes a rebate. Say an individual market insurer only spends 78% of premiums on actual care over a 3-year average, 2 points short of the 80% floor. It must refund that 2% difference directly to policyholders. In 2025, insurers issued about $1.6 billion in these rebates, reaching roughly 5.1 million people who bought individual coverage, according to KFF's analysis of the underlying regulatory filings. Since the rule began in 2012, cumulative rebates have reached roughly $14.4 billion. That sounds like a meaningful number until you set it against the industry's total size. $1.6 billion in rebates against roughly $1.7 trillion in revenue from just the 7 largest insurers works out to less than 0.1% of that revenue alone. Here is the part of this rule that surprises most people once they actually think through the arithmetic. Capping an insurer's profit at a percentage of premiums does nothing to stop the insurer from wanting premiums themselves to be as large as possible. Imagine an insurer capped at keeping 20% of whatever it collects. If total premiums collected are $1 billion, that 20% ceiling is worth $200 million. If total premiums instead reach $2 billion, that same 20% ceiling is now worth $400 million. The percentage never changed. The absolute dollar amount available to keep his profit and overhead doubled anyway, simply because the underlying premium base grew. A cap expressed as a share of revenue is not a cap on the total amount of money involved at all. This is precisely why the average cost of an employer-sponsored family health plan reached $26,993 a year in 2025, up from $25,572 in 2024, and 54% higher than the $17,545 average back in 2015. The medical loss ratio rule was never designed to hold total healthcare spending down. It was designed to control what fraction of that spending goes toward overhead and profit specifically. As long as the overall size of the pie keeps growing, the insurer's slice grows right along with it. Here is a detail that rarely makes it into conversations about health insurance regulation. The medical loss ratio rule only applies to fully insured plans, where the insurance company itself takes on the financial risk of paying claims. A large and growing share of employer health coverage in the United States works differently. In these self-funded plans, the employer itself actually pays the medical claims out of its own funds. The insurance company is hired only to administer the plan, process paperwork, and negotiate provider networks. According to KFF's analysis, roughly 2 out of every 3 people who get health insurance through their job are covered under one of these self-funded arrangements. For all of them, the 80, or 85% medical loss ratio floor simply does not apply because there is no traditional insurance risk being transferred at all. Instead, the insurer charges the employer administrative fees for running the plan, fees that are not subject to any comparable federal cap. There is no rebate mechanism, no minimum spending floor, and no requirement that a fixed share of the money involved go toward actual patient care. This matters enormously for how much protection the medical loss ratio rule actually provides in practice. A regulation frequently described as covering the health insurance market only meaningfully applies to roughly a third of employer-covered Americans, plus most people buying individual coverage on their own. To understand how much money rides on tiny movements in medical loss ratio, look at United Health Group, the largest insurer in the country. In 2025, the company reported total revenue of $447.6 billion, more than any other health insurer in America. Its insurance arm, United Healthcare, reported a medical care ratio of 89.1% for the full year, after running above 90% for stretches during the year. In the fourth quarter alone, that ratio hit 92.4%, well above where the company wanted it to sit. Do the arithmetic on what a single percentage point actually means at this scale. United Healthcare's employer and individual segment alone generated $79.2 billion in revenue in 2025. 1 percentage point of that revenue is roughly $792 million, moving in or out of the company's pocket. That single point sensitivity explains why United Healthcare's earnings from operations fell from $15.6 billion in 2024 to just $9.4 billion in 2025, even as revenue kept climbing. The operating margin fell from 5.2% to 2.7%, purely from rising medical costs outrunning premium increases. By early 2026, the company had responded aggressively, exiting unprofitable individual marketplace markets and pulling back from money-losing counties in its Medicare Advantage business. Its medical care ratio fell to 83.9% by the first quarter of 2026, and the stock market rewarded that improvement immediately. Not every part of the health insurance business runs on the same economics. United Healthcare gets more than 77% of its total revenue from government programs, mainly Medicare Advantage and Medicaid, even though its commercial plans still cover roughly twice as many people. That imbalance did not happen by accident. Since 2015, essentially all of United Healthcare's enrollment growth has come from Medicare Advantage and Medicaid. The company actually covered 80,000 fewer people in its commercial plans in 2025 than it did back in 2015, a full decade of commercial shrinkage. Government-sponsored plans, particularly Medicare Advantage, have historically carried more favorable economics for insurers than commercial group plans, with predictable government-set payment rates and an older population that generates steady, forecastable claims volume. That is not to say government business is risk-free. Reports through 2025 and 2026 show medical loss ratios climbing industry-wide inside Medicare Advantage too, as utilization by an aging enrollee base runs higher than insurers originally priced for, squeezing margins even in this historically profitable segment. The broader pattern, though, is unmistakable. Insurers are steadily shifting their business mix toward the government-funded side of American healthcare, even as they publicly market themselves around employer and individual commercial coverage that increasingly makes up a shrinking share of what they actually do. To understand why medical loss ratios ran so high across the industry in 2025, look at the underlying claims data reported to state regulators. In the small group insurance market, average monthly premiums rose from $615 per member in 2024 to $659 in 2025, a 7.2% increase. Claims costs in that same small group market rose faster. Average monthly claims per member climbed from $537 to $590 over the same period, a 10% increase, outpacing the premium growth meant to cover it. The individual insurance market showed an even sharper gap. Premiums rose only 3.1% in 2025, while claims costs rose 11%. When the cost of paying claims grows more than 3 times faster than the premium collected to fund those claims, the math simply does not work for very long. This is the underlying mechanism behind every high medical loss ratio reported across the industry in 2025. It was not one company mismanaging its business. It was a broad, industry-wide mismatch between how fast healthcare actually got more expensive and how fast insurers had priced their plans the year before. Insurers respond to that mismatch the same way every time. They raise premiums sharply the following year, exit markets and regions where the mismatch is worst, and tighten benefit designs, all in an effort to bring claims costs back in line with what customers are actually paying. The rebate mechanism inside the medical loss ratio rule sounds like it should catch overcharging quickly. In practice, the math is calculated using a rolling 3-year average, which means a company can run comfortably above its allowed profit margin for a stretch before any rebate becomes due. An insurer's 2025 medical loss ratio compliance, for example, gets calculated using data from 2022, 2023, and 2024 combined. If costs are climbing over that period, as they generally have been in recent years, the averaging effect can mask a genuinely excessive profit margin in any single strong year. This is also why total rebates have actually been shrinking. CapeFEF's analysis projects roughly $759 million in rebates across all commercial markets in 2026, well below the $1.6 billion issued in 2025 and the $958 million issued in 2024. Fewer rebates do not necessarily mean insurers are pricing more fairly. It can just as easily mean the industry has gotten better at pricing premiums close enough to the regulatory floor that rebate triggers rarely activate at all, extracting the maximum allowable margin without crossing the legal line. Average simple loss ratios reported across the industry in 2025 actually came in at 87% for small group plans and 91% for large group plans, both comfortably above their respective 80 and 85% floors. Most insurers are not breaking this rule. They're simply operating right up against it. Put every piece of this together, and a very different picture of health insurance regulation emerges than the one most people assume exists. The medical loss ratio rule genuinely does prevent insurers from pocketing an unlimited share of every premium dollar as pure profit. What it does not do is prevent the total size of that premium dollar pool from growing every single year. As healthcare costs rise, insurers are largely free to raise premiums to match, and their allowed profit margin simply scales up proportionally with that larger number. It also does not reach the roughly 2/3 of employer-covered Americans sitting inside self-funded plans, where insurers earn administrative fees entirely outside this framework, with no minimum spending requirement on actual care at all. And when insurers do occasionally overshoot their allowed margin, the resulting rebate arrives calculated against a 3-year average, often years after the excess profit was actually collected, and increasingly for amounts that barely register against overall industry revenue. The next time your employer mentions the cost of your health plan going up again, remember what is actually happening underneath that number. A federal law does cap the insurer's percentage. Nothing comparable caps the size of the number that percentage gets applied to, and that gap is where most of the real money quietly lives.